Welcome those of you who are on the call to our today's webinar. As you can see, Gustavson School of Business has responded to the need of people in the community who are looking both for support as well as for content with this Uncharted Waters webinar series. Today is the first of a series of talks that will be given over the next month with different faculty members contributing content in ways that we hope will be valuable to you as members of not only UVic community, but also of Victoria and perhaps further away as we deal with the current pandemic. So my name is actually Michael King. I'm a faculty member here at Gustavson where I'm a finance professor. I've been with Gustavson since this past summer, and prior to that was at Ivy Business School for 8 years. But more importantly for today's talk is my background in central banking, particularly over the 10 years that culminated with the global financial crisis of 2008 to 2009. As a senior economist both at the Bank of Canada and then at the BIS in Basel, Switzerland, I used to give briefings like this to the governors as well as senior management at the BIS when we were trying to tackle what was going on with the disruptions that followed Lehman Brothers collapse. Today you will see that everyone is joined with your cameras off and on mute, but you have the ability to send questions via the chat. If you're not familiar with a Zoom webinar, you should be able to find the chat either at the top or the bottom, depending on what device you're using. And I've got times, as you can see in the schedule, I've broken up the talk into two parts. So I'll start by giving my view on where we stand. We're actually in the second phase of 3 phases of the economic crisis related to the COVID-19 pandemic. I'll speak about that as well as look at what happened in phases, the first phase, and then I'll take a break, open up for Q&A through the chat function for 10 minutes. And then we'll dive into the second part of the presentation, which will cover phases 2 and 3. And then we'll have a final session of Q&A before closing off, and we should all be done by around 3:55 to 4 o'clock.
Sorry, Michael, just before you get started, we've disabled the chat, so we will not be doing it through the chat. They'll just have to use the Q&A at the bottom of their screens, questions and comments.
Okay, so there's a feature called Q&A, which you'll see at the bottom of your screen. So the chat has been disabled, I'm told. So it's another feature similar to chat, but it's specific to Zoom webinars. And as you can tell, Callie and some other are going to be monitoring that and helping to keep track so that we don't lose your questions. Okay, thank you, Callie. One of the things that's made this pandemic so difficult is the lack of reliable data on where we stand, both from the health point of view as well as the economic point of view. This is clearly a different type of shock that's hitting the economy from what we've experienced in previous crises. If you think back to the 2008, 2009 to 2001 dot-com bubble, maybe the late 1990s with LTCM or with the Asian financial crisis. These crises started in the financial system. They started with banks, they started with the exchange rate, maybe with sovereign debt. That is not the case of what we're seeing today. We're seeing a health crisis, which has become a confidence crisis. And you know, we're all obviously living with reports of the number of infections and uncertain statistics on how many people are actually infected, as well as the sad mortality rates that we're experiencing. The slide that you see in front of you now actually is based on data collected by Johns Hopkins University, which is this visualization. You've probably seen a number of these curves as we're trying to reduce the number of cases. What I'm going to show you really is just 3 different ways of looking at this data to kind of give you a sense of how you can find good news, bad news, or perhaps a different way of looking at this by looking at this data. Here we see the traditional picture with an exponential or a logarithmic scale. You can see that the United States has climbed but is now net flattening off. If I was to show you this on a linear scale, however, where now the axis on the horizontal axis goes up by hundreds of thousands, you get quite a dramatic different picture from the exponential scale. You can see that the number of cases in the United States has been accelerating, and over the 2 weeks that I've been talking to people about what's going on, the United States has gone from 130,000 to now over 600,000 cases. Probably a better way of looking at this is to normalize the data, to look at it in terms of the number of infections, in terms of millions of the population. And when you look at it this way, obviously the United States being a very large population, it appears to be tracking the same path as Italy, with a lower rate of infections per million than Spain, Switzerland, Iceland, or some other countries. Canada, we've been very fortunate in that we closed down very rapidly, and this has obviously helped us to avoid the high number of cases that we're seeing in the United States. But still, globally, we're perhaps, we're over 2 million cases with the reported fatality rate at around 6.6%. However, the number of cases is maybe underreported by a factor of 4 to 8 times based on what we're hearing from epidemiologists. So it just highlights how incredibly uncertain this whole event is, and also how rapidly it began. So we're really into the second phase of the crisis, and what do I mean by that? Well, the first phase of an economic crisis caused by the COVID-19 outbreak has been a panic in the financial markets, and the policymakers, whether at the central bank or the finance ministries, have injected money into markets, have brought forward fiscal stimulus packages to basically restore confidence and put a floor underneath the markets. And they've been successful in doing that, as we'll see. The second phase where we are now is the question of how long is the global lockdown going to continue? We're all practicing social distancing, but we already see some evidence that countries in Europe are opening up, such as Denmark or Sweden. And at the same time, we're seeing other countries that have opened up earlier closing down, such as Singapore or Singapore and Japan. So social distancing is obviously going to save lives, but it also has repercussions for the economy. So there's a big debate, obviously, right now about how long that will last. The third stage, once we do end the lockdown, when social distancing is formally ended, is going to be a recession. And the question is how deep and how long the recession will be, and what shape will the recovery take of the economy? Will it be a V, meaning a rapid shift? Will it be a U? Or will we have a drop and then move sideways in an L-shaped pattern? And what people will be watching for is the number of bankruptcies, how many people who lost employment or were furloughed continue in unemployment is what we're going to be following. So let's move into the first phase and kind of set the stage where we are today. Really, even though the crisis began in late December, early January in Wuhan, China, and spread from there to Italy and subsequently to Spain, it did not really arrive in Canada or the United States until March. But once it did, we see that from this slide that there was actions taken both at the national level in Canada, but also some coordination at the international level. First with the G7 finance ministers who met at the start of March, and then the leaders themselves, meaning the presidents, the prime ministers, the heads of state, meeting in the middle of the month, and pledging basically to do whatever is necessary. Canada's initial package of 27 billion was doubled shortly afterwards. At the same time, the United States brought in a $2 trillion stimulus package, which, hearkening back to the 2008, the fall of 2008, when the TARP was announced, it was proposed by politicians, voted down, and then finally approved. One thing to keep in mind is that when you look at these actions is that central banks have been able to move more quickly, more rapidly, because they really control the tools that they have, whether it's money market operations, whether it's the overnight policy rate, whereas politicians have really been hampered because they need to reach consensus and move through the institutions of government. which has taken longer, but fortunately we've seen them act very quickly. And in Canada's case, certainly adopt many of the best policies that we've seen overseas. Just to give you an example of the scale of the fiscal stimulus that we're seeing, both Canada and the United States have brought in packages that are around 10% of GDP. Canada's initial package was much smaller and has been increased as the need has grown. The United States at 10% of GDP will probably see more stimulus in the coming months. These were the initial steps, both to help individuals by sending out checks or somehow helping them with their finances as they've been laid off, but also importantly with businesses, providing guarantees on debt, emergency loans, and also deferring taxes for both individuals and firms. And these steps are really radical. What we're seeing here in real time is the introduction of a universal basic income scheme, which for many was debated for decades and has been brought in really with rapid light speed in terms of the political scale into a reality, which is very much showing how politicians are motivated to help and support the economy. How have the stock markets reacted? Well, what we're seeing here is the Toronto Stock Exchange Composite in the top left, the blue bars. I'm showing you a picture here from the peak, which happened on February 20th. The peak was following almost 11 years of uninterrupted increases of a bull market. And what we saw starting in February was a rapid decline, which really accelerated towards the middle of March. If you look at the bottom left, you'll see the red bars showing the daily change in terms of a percentage drop. And what's quite notable is that you see not only drops of 10 to 12%, but immediately followed by increases the next day of also 5 to 10%. These drops followed by recoveries are typical of what we call a bear market. A bear market, we call a fall in the stock market of 10% a correction. We call a fall of 20% or greater a bear market. And Canada entered a bear market, as you can see, by the 11th of March. If you look on the right-hand side of your screen, you can see that we had a drop of 12%, which was a historic record in the post-war era, followed by a 9% climb the next day and then a 9% drop. This kind of volatility is unprecedented, and you may be wondering what's causing it. Part of it is the increase in automation of trading, which has been brought in over the past 15 years. The growth of exchange traded funds requiring rebalancing towards the end of each day. Those funds tend to track indices, and they have to have the same holdings, and they have to rebalance to match the holdings of the overall stock market that has fallen. At one point in the middle of towards the end of March, the stock exchange was down 43%, a remarkable drop in a period of only a week and a half. And it has subsequently bounced back in response to the fiscal stimulus as well as the central bank interventions to a point where, as of a day and a half ago, it was down only 18%. The United States, obviously, Canada has mirrored what's going on in the United States. This purple chart shows the S&P 500, which is the index of the 500 largest companies in the United States by market capitalization. We saw an equally rapid drop. We saw the same volatility with huge declines, followed by rapid bounces on the next day, this kind of seesawing back and forth. The S&P 500 was down by 38%. Also at the same point on March 23rd, and in response to stimulus, in particular the $2 trillion stimulus, or at least rumors of that stimulus coming, the market jumped 7% on the 6th of April and has subsequently recovered to now only down 13%. This is, these large movements in markets are often called volatility, and one of the main indices that people will track is something called the VIX. The VIX is a volatility index based on the prices of options traded on the S&P 500 index of those 500 largest companies. What you see in the middle of your screen here is a large spike in a gray area, which was the 2008-2009 global financial crisis. And you can see the VIX, which is sometimes called the fear gauge, jumped to over 75, almost 80%. Normally, in normal periods, we'd see the VIX below 15 to 20%, and that was the case running up into January and February of this year. At the far right of your screen in the red box, we saw a rapid increase in the middle of March, up to 65%. And fortunately, the VIX has come down to in the 40s, but remains very elevated by historical standards. It's not only stock markets that have been seeing tremendous volatility. We also see here a picture of the oil price, looking at the benchmark oil price for West Texas Intermediate, which is the benchmark crude oil price for the United States. Many of you may not know this, but actually prior to the onset of the 2008 financial crisis, oil had topped almost $150 a barrel. This chart shows 140 because it's monthly averages. And you can see that during the financial crisis, particularly in the fall of 2008, start of 2009, it dropped down to $40 a barrel. It subsequently recovered, and in recent times, we did have a drop as 2015, 2016. This drop obviously was felt very much by the Alberta economy because a drop below $60 a barrel really is painful for producers in Western Canada. That drop, incidentally, was caused by an increase in production by Saudi Arabia and by OPEC, which was then reduced until about 3 weeks to a month ago. About 3 weeks to a month ago, we had the combination of the crisis spreading, leading to a 20% drop in demand due to people driving less, industrial production falling, fewer flights, and other demands for oil. And at the same time, we had a failed meeting between OPEC, which are the organization of petroleum exporting countries, mostly out of the Middle East, but also some other Latin American countries, and Russia, which is a non-OPEC member and also a large oil producer. They disagreed on setting production cuts, which set the stage for a price war, and they both began increasing their oil production, which caused oil prices to drop to below $20 a barrel. What does this mean for Canada? Well, as an oil exporting country where our currency is quite closely tied, it's had important repercussions. You can see just a close-up of the recent oil price for the West Texas Intermediate on the left. But more importantly for Canada on the right, you see the two lines. The top black line is showing the price of West Texas Intermediate. And the line below that, the blue line, is the price of a benchmark barrel of oil out of Western Canada, which is called Western Canadian Select. You can think of it as the price for a barrel of oil from the oil sands. You will see that there's always been a gap between West Texas Intermediate and Western Canadian Select, which is due to the cost of actually shipping oil from Alberta down to refineries and to hubs in the United States where it can be refined and transported. Those refinery and transportation costs add another $5 to $10, which explains the gap there. With the drop in West Texas Intermediate, Western Canadian Select oil has fallen to as low as $4 a barrel. It subsequently bounced back to $7. But really, at this point, that the entire industry that we have in Canada is uneconomic because we're not even covering the cost of transportation, not to mention the cost of extraction. Now, as we'll see later, the recent IMF World Economic Outlook does expect oil prices to return to levels around $35 to $40 a barrel, but obviously that's a forecast based on where the forward curve is today. Canada's currency has, over the past 15 years, become quite closely tied to the oil price. Our currency moves based on not only oil prices, but non-energy commodity exports such as metals, as well as the interest rate differential with the United States. This chart on the left will show you in red the Canadian dollar and in blue oil prices. And over the past 10 years, they've moved at an 88% correlation. Okay. On the right, we can see that the Canadian dollar fell from around 75 cents US to the dollar to only 69 cents, so a depreciation in the Canadian dollar. For those of you who look back longer, the Canadian dollar did reach below 62 cents in the past 20 years. Although it was up at par around 2009, 2010 during the financial crisis, meaning it traded at $1 US to 1 Canadian. It has bounced back, but continues to be at around 70 cents, which should help our exports. But it's not really exports that are really driving the Canadian dollar movements. It's really a flight to safety of money all around the world. We're seeing a flight into the US dollar, into the euro, into the Japanese yen, which is a typical pattern that we see during a financial crisis as people move their money out of risky assets abroad, move it back into those countries, particularly into short-term money market instruments. Well, how have the central banks responded? In Canada, we've seen that the Bank of Canada, our central bank, has cut rates following on rate cuts that have been seen in the United States by the Federal Reserve. The Federal Reserve actually cut rates twice in 2 steps, one at 50 and one by 100 basis points. And that has brought their overnight rate target down to 0, the bottom end of a range that they have, effectively hitting a 0 lower bound. Canada has moved down in 3 steps, hit a level of 25 basis points or 0.25% for our overnight rate or the 1-day rate as of March 27th. And in comments to the press just yesterday, Governor Polas, our central bank governor, has said that's effectively the lower bound for Canadian interest rates. How is that affecting the economy? Well, when the central bank changes policy rates, it tends to affect the economy with a lag of 12 to 18 months. It will work its way out by lowering the cost of borrowing in other maturities, and that's what we see on the right here. We see that the 5-year government benchmark rates in both Canada and the United States have come down. You can see that the US government borrowing rate has come down below 0.5%, and Canada's 5-year rate is slightly higher at around 0.6%. I'm showing you the 5-year rate because the 5-year rate is a good indicator of what would happen with fixed mortgage rates. Although what we're seeing in both the short-term rate and the 5-year rate is that banks in Canada are not able to match that in terms of lowering borrowing rates, both the prime rate and the mortgage rates, because of concerns about looming credit defaults and concerns about the creditworthiness of borrowers. Last slide before we open up for questions. This slide, which I borrowed from Investopedia, it basically looks at bear markets for the United States S&P 500 going back to the 1950s. It takes a moment to kind of get the picture here. What I want you to look at is the bars, the light blue bars below the axis show how far the S&P 500, the S&P 500 fell from its peak at the top of a bull market to its trough at the bottom of the bear market. You can see, for example, in the red box that it shows that the market fell by 30%. The box immediately, the bars immediately to the left show the 2008-2009 financial crisis, and you can see that the stock market fell by 57% over that period. How long did it take? Well, the darker blue bar above the axis shows the number of months. You can see that the decline in the previous crisis lasted for 17 months, almost a year and a half, from the start in October 2007 to the bottom in March 2009. Subsequently, the orange bars show you how long it took to recover that loss. And we can see that in the last crisis, it took 49 months, which was only the first part of an extended bull market, that lasted for 11 years in the United States, an unprecedented run that saw the market rise by 339% and culminated in early March of this year. What you should take away from this chart is that we have seen as much as a 40% decline in Canada and a 35% decline in the US. There is potential for the markets to correct lower over the coming months. Bear markets tend to last not only days, they last for months, and in some cases, potentially a year or more. So we are at the very start of what could be a difficult time for the economy. And that's where we're going to go to next. For the moment, what I'm going to do is I'm going to open up the chat, take questions before continuing with the second part of our talk. Okay. So the first question I have is asked by Knightley. She understands that the Fed is spending 2.3 trillion in the next 6 weeks to purchase commercial paper securities, over and above the trillions that have been spent to prop up the market. The Fed is intervening in the treasury markets, the municipal bond markets, the corporate bond markets, both investment grade and junk bond markets, or below investment grade, CP, as well as other markets. Now, Knightley is pointing out that it seems like the Fed is, the debt of the United States is being nationalized, and this purchasing of debt, quantitative easing, will it crash the world economy? And what is the best way to protect against this? Knightley, the concerns you have about quantitative easing and government, the central bank purchases of debt are shared by a large number of observers. Within the central bank world, they view this as a necessary evil in order to prevent what they call a risk of deflation. So the central banks are playing from a playbook that they got out of the last financial crisis. The last financial crisis, they were slower to act, but introduced all of these facilities to basically help and get money into the hands, or at least loans into the hands of different parties, such as small businesses, large corporations, and individuals, while trying to prevent the underlying plumbing of the financial markets from stopping. What they saw was liquidity drying up, and this is what caused the decline in the stock market in the 1929 stock market crash to lead to what was now known as the Great Depression. It led to bankruptcies on massive scales. It led to thousands of banks in the US failing, and that led to a multi-year, very deep and difficult time for the United States. The US, Europe, Japan, Canada are all purchasing government debt, and you may be wondering if this is going to lead to inflation. There is a risk that it could be inflationary, but only once the economy closes a gap between what its potential is and where it is today. When you get that gap closing, more demand in the economy can only be met by pushing up prices, which is inflation. But when you have that gap, which is what we have today, you have a risk of deflation, and the policymakers are trying to push it up. There is a risk that this will cause what's called moral hazard, which means that borrowers will feel like they are not responsible for the debts. That is something that's going to be managed very carefully, not only by the central bank, but also by the private sector, who are going to be helping with this. So it is certainly a difficult time, and one that is unprecedented, and we'll have to see how this plays out. Next question, Jack is asking, how resilient is the Canadian economy versus the US economy? Does the Bank of Canada have similar tools to the US Fed? Jack, unfortunately, the Canadian economy is less resilient than the US economy. Canada is still largely a commodity exporting economy and is going to be more vulnerable to the drop in commodity prices, whether it's the price of oil, the price of base metals, the price of wood, other natural resources. Canada is going to feel pain from the drop in those prices, particularly as demand has declined. Much of Canada's exports of both manufacturing and services go to the US. So we cannot see a sustained recovery in Canada until there is a sustained recovery in the United States. So although our business cycles are not typically fully moving together, Canada does tend to experience the same cycles that the United States finds. Now, in terms of whether we have the tools, yes, Canada's central bank started off in a better position than the Fed, with a smaller balance sheet, with interest rates at a higher level, with a banking system that was sound. But we also started from a position where corporate debts were high, and in particular, personal debts of Canadian households were at historically low levels. So it is a delicate situation, one that is going to be difficult, which is why the central bank in Canada has moved quite rapidly into the same markets that the Fed did, supporting commercial paper, bankers' acceptances, and making both purchases of government debt in the primary markets for short-term debt and in the secondary markets for longer-term debt. Ash is again asking, why has the Canadian government not mandated banks to provide debt relief in the same way that provincial governments have mandated landlords who are not allowed to evict tenants who have not paid their rent? Well, the Canadian government is not mandating what banks can do, but it is encouraging banks by providing both guarantees on debts that are being made through their lending facilities, as well as covering losses on loans to small businesses. For example, the $40,000 loans that are being made to small businesses, the Canadian government will cover the first $10,000 of losses on those loans. And through BDC and Export Development Bank, which are two crown corporations, but also banks that lend, the Canadian government is providing lending. But our government is not in the position of telling our banks what to do. It is able to work with the banks to convince them what's in the best interest of the banks, which is to maintain, to help their borrowers to avoid default. But the government is not in a position to tell the banks what to do or to necessarily mandate what can be done in the financial markets. The restrictions that you're pointing out that provincial governments have made to landlords, I'm not aware that those are legally binding. It may be what we call moral suasion, but we certainly are seeing some more interventionist policies in Europe, for example. And it's not beyond expecting that we could see a government, a more direct intervention into the mortgage markets as well as the personal lending markets. We're getting another question about how this is likely to affect the real estate market. What kind of movement will the bear market in stocks see, and how long will this happen? Well, as you probably know, the real estate markets have slowed down quite significantly. Reports that we saw for March were really on transactions that have been initiated either in February or the beginning of March, before we really felt, before the WHO declared a pandemic. Clearly, people are not going to want to have potential buyers traipsing through their homes because of social distancing. Clearly, it's going to be very difficult for people to get financing with a mortgage, particularly if they have one, because of the concerns that the banks are going to find to lend. Banks are going to be very cautious because as they help individual borrowers to postpone mortgage payments, they're not going to be in the mood to provide more mortgage payments. And we've actually seen an initial drop in the mortgage rate followed by an increase. And I think that actually lending standards for individuals as well as for businesses are going to be tightened. The stock market, certainly we could see a decline in the stock market. I'll come to that in a moment. It really depends on your view on whether we're towards the middle of this crisis or closer towards the end, and how long it'll be until we actually see a opening up of economic activity. And more importantly, whether we're able to get a vaccine into production, how quickly we can get it out, although most people would say that that's 12 to 18 months until it's widely available. Another question is, someone was asking if the real estate market in Vancouver Island is going to be hit similar to the real estate market in Vancouver, Montreal, and Toronto. I believe it will be. I think this is something that will actually happen across Canada. Question here from Nolan. Interested in the opinion on potential bailouts on the Canadian oil and gas industry from an economic perspective. Does it make sense to prop up an industry that is largely uneconomic at these oil prices and cannot deploy capital? Should there be bailouts? Nolan, I have to agree with you that really it's much more of a political decision rather than an economic decision at this point to support manufacturers in the oil sector. I believe the governments, both provincial and federal, are most concerned about Albertans, about employees in that sector, people who work with energy companies. The large oil companies that employ them certainly are able to weather this storm. They're operating globally and have access to funding markets globally. And what we're really concerned about is trying to maintain employment and to support confidence in the province. It will heavily depend on both oil and natural gas prices recovering. Although even prior to the COVID-19 crisis, it was becoming clear that the economic, with the climate crisis, which we haven't been talking about, there was going to have to be changes made towards alternative sources of energy. So apart from acknowledging that it's going to be a very difficult time for the oil sector in Canada and energy, it's hard to say what's going to happen next. Given the current situation, Evan is asking, do I think the economic crisis now will be worse than the stock market crash in 1929? No, I do not. I do not, because the 1929 crisis was followed by a period of very ineffective policies. We've learned quite a lot, both from studies of the Great Depression and the monetary policy that was not, the steps that were not taken in the Great Depression. However, every crisis is slightly different, and initially in the first weeks of this crisis, it was not clear that policymakers had fully grasped the importance of a fiscal response, even though the central banks were responding. They did get the message very rapidly, which is why we saw such large scale, large volume, wide fiscal stimulus. We will now have to see whether that's going to be enough, although we can expect to see more steps taken in the coming weeks. I'm going to take just a couple more questions here. A question about exchange rates. Exchange rates are going to be very difficult to predict, as they always are. For anyone who's studied exchange rates, you know that they follow a random walk. They tend to be driven very much by both capital flows on one hand, interest rates differentials on the other, but also speculation. And there's a lot of, as I mentioned, a lot of the capital flows that we're seeing right now are being driven by safe haven flows. Liam is asking, what will be the long-term impacts of such an increase of government spending and government debt on the economy? Well, we're going to come to that in the second half of the talk. Clearly, any debt taken out today is going to be, has to be paid for by taxes or by reducing expenditures. Okay, this debt is owed by Canadians, even though it's being taken out by the Canadian government, and that means that we're going to have to all pay it in the future. Okay. Okay, let me get back to the presentation and get going with the second half. So how long do I think? Well, phase two. If phase one was stopping the panic, which we've done, phase two is how long are we going to be in a global lockdown? And this is a phrase that's been coined by the World Economic Outlook, by IMF, in their report that was just published yesterday. The answer is, depends on what you think the path will be for the spread of the coronavirus. Okay. What we see here is a chart that was prepared by epidemiologists at Simon Fraser University. A very similar chart was prepared by epidemiologists at Imperial College London to inform policy in Europe and the United States. We have basically three scenarios. The scenario with no intervention, where many people become infected with the virus. Many become sick and hospitalized, overwhelming hospitals. That is the scenario that we've tried to avoid by having the lockdown as well as self-distancing. And we appear to be in the scenario which is the bottom right, which is the period of strong intervention. As you can see here, strong intervention means that the economy is effectively slowed down or closed until the end of the year. So right now, there's a debate going on in financial markets, in policy circles, in economic circles, and people seem to be on one of two sides. You either believe the epidemiologists that we cannot rush this, that these social distancing measures and economic slowdowns are important, that we have to flatten the curve and avoid resurgence or opening up too soon to have another wave of cases, something that we saw a little bit in Singapore and in Japan recently. These epidemiologists will say that the data that we're using to make our decisions is highly uncertain, that we have a lack of testing, that we have underreported deaths as well as cases of contagion, which makes it very hard to make decisions. There is another point of view, and the other point of view is optimists who say that we've panicked for no reason. This is no worse than a seasonal flu, that the fatality rate and the infection rate, while the infection rate tends to be very low, that the fatality rate is very low. To put this in perspective, a typical flu season in Canada will see 1,500 to 3,500 deaths, depending on its severity. As you saw at the start, we've had about 1,100 deaths in Canada from this pandemic, which many people are wondering whether we've overreacted, similar to what happened with Y2K. Those kind of people are going to argue for an opening up the economy by the summer and getting back to business, because the longer you keep the economy shut, the harder the cost is on small businesses, on employees that are being forced to stay at home and not have income, and many of those businesses will not recover, and many people may be in unemployment for a considerable amount of time. I don't have an answer, but this is certainly the backdrop of what's going on in this second phase. We could be reopening already by the summer. There's talk in Europe, Denmark, Sweden, Austria are already starting to reopen. China has reopened. We're seeing even some businesses reopening in Italy and potentially in Spain. At the same time, other countries are finding that they have to shut down again, having opened too quickly. And I think in Canada, we're certainly going to be listening very carefully to health authorities and their guidance on this, which is what's benefited us so far in terms of controlling the number of infections. One thing is certain, many people are being hurt and are losing their jobs. And what I show here is the job losses in the United States. As you can see here, the chart along the bottom, the gray bar shows you the typical unemployment claims by week that we would experience in the United States. The small bump that you see under the title that says recession is the 2008-2009 recession, when from an average of around 200 to 250,000 initial jobless claims every week, we saw them increase to 500,000, a doubling. The jobless claims that we've seen out of the US over the past 4 weeks have been off the charts. As you can see here, just in the table, they went from the typical 200 to 280,000 to 3.3 million to 7 million to 5 million for a total of 22 million job losses. 22 million job losses on a working population of 160 million means that the unemployment rate in the United States may have increased as high as 17% within 1 month. Okay, these numbers have never been seen before and point to just how sharply the problem is. Of course, unemployment claims do not include people who have been furloughed and are inactive at work, which suggests that in terms of working population, it's fallen even more than this amount. How is this affecting spending? Well, as you know from your economics, one of the main drivers of GDP is consumer spending, and this is a chart from The Economist showing two charts for, well, the gray chart is the same in each of these different panels. It's overall consumer spending indexed to 100 at the start of the year. You can see an interesting pattern here that spending actually peaked, rose up as we started to see the pandemic spreading, as people recognizing that they were going to be closed off, recognizing that they needed to stockpile, went out and purchased groceries. They went out and they made other purchases. They went to restaurants. And if you like, they built up inventory, which is why we saw an increase in spending of almost 50% by the end of February, the start of March. What happens after you get an inventory buildup is you get a crash or a decline. And what we've seen is that there's been a fall across the board, obviously more dramatic for air travel, for retail services, for public transportation, but even a fall in groceries and food delivery, suggesting that many people are basically are consuming their stockpiles, but also consuming their spending as we face this kind of problem. In Canada, This is coming from the Bank of Canada's Monetary Policy Report, which was released 2 days ago. You can see the top left chart. The red line shows losses of jobs. The drop has fallen to about 1 million jobs in Canada, okay? Which is also meaning that our population, given our smaller population, we're seeing an increase of unemployment to double digits. The chart at the top right, the red line is the most recent year, 2020, and it's compared against spending using Interact against the previous 2 years in the other two colors. And what this is trying to show you is that spending, even using debit, which is the main form of currency that's being used, the main form of payment, is down dramatically over the month of March. Okay. The bottom two charts effectively are showing you confidence, one for consumers, one for businesses, particularly small businesses. And you can see the confidence has dropped dramatically and is only starting to rebound. These are all things that are going to really weigh on the economy as we go forward. Which brings us to phase 3. Phase 3 is really about a recession, which is certain, and a recovery, which is uncertain. If we go back and we look at where we stood at the start of the year, the Bank of Canada in their January Monetary Policy Report, they provided this useful table which helps you get your head around global GDP. As you can see here, we have countries on the left, the United States, Euro area, Japan, etc. And the US represents around 15% of global output, China around 19%. We see that the Euro area is smaller at 11, Japan at 4, and oil importing emerging markets is around 1/3 of global GDP. Okay. If you move to the red box, you can see what the prediction was. You can see that overall GDP globally was supposed to grow at around 3%. The United States and Canada were both around 2. Europe was slower. China was up at around 6, having decelerated from a rate around 9 to 8% over the recent years. But overall, emerging markets were balancing out the advanced economies for a relatively good growth rate. Where do we stand now? Well, for one, the Bank of Canada has decided in its most recent monetary policy report not even to put out a forecast. Okay? This cover was chosen for the monetary policy report because it's the 25th anniversary of the publication of this report, which comes out every semi-annually. And it basically provides a forecast of where GDP, inflation, unemployment, and other key variables are going. As Governor Polosh explained in his comments to the media, there's no point in putting out a forecast at this time. It is so uncertain that the only thing that the bank can do is put out scenarios that seem plausible, both a good or a base case scenario as well as a more severe scenario. Okay? So Canada is not in a position where we understand what the impact is going to be. When it comes to the world, we can look to the IMF. The IMF put out in the World Economic Outlook yesterday this chart. As you can see on the left, the global economy grew by 2.9%. It's predicted for all of 2019. And we're expecting a slowdown or a recession with a 3% decline in world GDP over the course of 2020, followed by a recovery in 2021 of 5.8%. The slowdown in 2020 is going to be largely driven by the advanced economies in the middle of this table, where you can see countries like Canada and the United States are going to see a decline of 6%. If you go to the far right, advanced economies are going to see a slowdown of around 1% on average. You may be wondering, okay, well, what does this mean? Well, only 2 months ago, world GDP was supposed to be 3.3% for the coming year, which means that the drop has been 6.3 percentage points, from a 3% increase to a 3% decline. When it comes to the advanced economies and to the emerging markets, you can see that the drop in the advanced economies is much, much sharper, almost 7 percentage points. And in the emerging markets, it's 4. Who's really driving this decline? Well, you can see here that it's the United States, Europe, and Japan. And for comparison purposes, the left shows what's expected now for 2020, The right-hand side of your screen shows what happened during the last financial crisis of 2008, 2009. As you can see, the United States had a contraction after that crisis of around 2.5% and is now expecting a contraction of 6%. Europe, much greater. What's interesting is that you may think, well, the purple chart showing China is expected to grow by 1%. However, a growth rate of below 4 to 5% in China feels like a recession for that economy because of its size and because of the amount of people who are moving into the workforce, joining the workforce over the past 10 years. You can see that China was expected to grow at around at 6 to 7% and will now be seeing only 1% growth, quite a sharp drop. Also, India will be experiencing a very sharp drop. So what does that mean? What are we looking to in terms of the recovery? Well, the IMF is showing the two scenarios. This is the middle of their forecast. You can see the blue line is showing what they expect for the advanced economies. This is what we mean by a V. You see the drop in 2020, a drop that bottoms out in the second quarter and then recovers with a slow recovery through 2021. The emerging markets have experienced it faster because of China being hit in the first quarter rather than the second quarter. And what you see is the decline where it is below the trend path that was present, which means that the gap below that dotted line is really the destruction of growth. One way to look at it, above where we were before. When it comes to Canada, the Bank of Canada did put out this scenario. The top chart looks at the period from 2006 to 2022. You can see that they've shown the path of GDP, and then they have within the gray bar a large range where they're showing confidence intervals. Okay, the bottom half of that chart shows you just 2018 to 2022, and you can see that the confidence intervals are very large. What this means is that you could fit a U shape into that, you could fit an L shape. We're not sure. We're simply not sure, which is why uncertainty is just such a problem. When it comes to what is causing it to be uncertain, this comes straight out of the World Economic Outlook from the IMF. You can see here in red the things that are negative, in green the things that are positive, and blue the things that could be either positive or negative. Obviously, we would hope that we're going to have a vaccine. There's going to be lots of stories about vaccines being available, but if you listen to health officials, to epidemiologists, to our own Prime Minister, it will not be in wide distribution for 12 to 18 months. Finding a vaccine and testing it does not mean everyone gets vaccinated within a month. It takes time. So containment and self-distancing is going to have to continue over that period. In the meantime, there's been structural breaks or damage to the economy that we're not sure how long it's going to last, particularly cross-border supply chains. We don't know if people are going to want to go back to stores. We don't know if people are going to want to travel. We don't know if restaurants are going to survive, small businesses are going to make it, and confidence is going to remain fragile. What we do know is, coming back to the question posed by Liam earlier, government debt levels are going to be very high, and this is going to present a drag on the economy for years to come. On the left, we can see numbers for GDP to debt to GDP for Europe. You can see that Germany and Denmark and the Netherlands are in a much better situation to add debt than, say, Greece, Spain, or Italy at this point in time, where debt levels are 100% or more. The United States was looking at debt, federal debt, at the level of around 80% of US GDP. They're now forecasting, based on all the promises that have been made, that it will be over 100%, a level that the United States has not seen, 100% of GDP, a level that has not been seen since the Second World War in the United States. So even the United States is going to have high debt levels, and as you can see, this forecast shows some very large bounds, which means it could be significantly higher, even close to 115%. Canada's debt levels are relatively modest, both at the federal level, where it's around 55%. When you add in provincial debt, it's closer to 100%. we have the capacity, we have the borrowing capacity, we have the rating to increase those debt levels because of all the frugality and because of the balanced budgets that were run during the 1990s and the 2000s. Canada's debt will also go up, however. Okay, with that, I want to open it up for questions, and we'll try and get. I recognize that we're coming to the end of our hour, but I'll take a few questions here, and then we'll close. So I think I've talked about the debt question. Obviously, we're going to have to look at longer taxes as we have more debt and people anticipate taxes. That affects their consumption today as people recognize that they have to pay more taxes. They have to save more, which means slower growth. Does the Bank of Canada have unused levers to leverage over the next 6 to 12 months? No, not really. The Bank of Canada has really pulled out the bazooka already. They're already intervening in government debt markets, in commercial paper markets, helping corporations. They're intervening in bankers' acceptances markets, which is really helping banks to make loans. The interest rate is really close to the lower bound. The Bank of Canada is really doing its most that it can to maintain to ensure that the markets function. But this is really in the hands of politicians. This is really about fiscal stimulus. This is really about the private sector. The question is going to be, are private companies going to step up, spend, and hire at this time? We're more than likely to see the government increase spending, but in the form of infrastructure. We've seen stories already that infrastructure spending will increase. Oswald, I hear a lot about stock buybacks fueling the stock market rise since the last recession. Could you comment on stock buybacks? I think it's fair to say that stock buybacks were, yes, a deceptive driver of the bull market, particularly over the past couple of years. Both in the United States and Canada, companies were employing money to prop up their share price rather than investing in R&D or making necessary capital expenditures. This was good for shareholders. It was not good in the long term for the economy or for shareholders, for that matter, because what we're going to see now is that stock buybacks are going to be canceled, and potentially we're going to see dividend cuts. Okay. How were the stock buybacks funded? They were funded by debt in some cases, in some industries. Fortunately, not in the banking system. The banking system was not able to raise debt to fund stock buybacks because of capital requirements that were brought in under Basel, but private sector companies certainly did increase their leverage, which obviously is going to hurt them going into this recession. So we are going to see stock buybacks stop, and we're going to see debt levels rise. We have heard, sorry, I've got a question for Alam. I'm interested to know if you believe the effects of this future recession will be magnified by consumer debt and leveraging by investors. Yes. Okay. A lot of the views of people prior to COVID-19, prior to the pandemic, was that leverage was really fueling the rise in both stock markets and real estate, which is a classic asset bubble. Stock market and real estate bubbles have always been linked to cycles of credit markets, to over availability of credit and low costs. You will start to see stories about companies that were where their cost of borrowing was artificially low because of quantitative easing, as well as people not properly pricing risk. And what we're going to see is we're going to see a repricing of credit. We're going to see a raise in the cost, and people who are leveraged are going to start to get squeezed. It's really going to affect consumers as well as businesses' ability to spend. So you can see that credit helps during the up cycle, but it really it deepens the recession when things turn around. AB is saying, I heard there was a significant market reset in the 1950s. Can there be a case here for some past sins being washed away? Yes, AB, there are certainly parallels to prior bear markets where a lot of the analogy has been used to forest fires. We've seen since Greenspan in the 1990s, followed by Bernanke and now Powell, central bank governors in the United States that have put a floor or a put underneath the equity market. which has allowed a lot of irrational exuberance and has made it basically a one-way bet. Okay? Now with the central bank basically their balance sheets ballooning and their ability to intervene, the question is, should businesses be allowed to fail? Do we need to have are forest fires necessary in order to restore the healthy ecosystem in a forest? I think people would say that a controlled burn is good. We don't want to see a wholesale fire that's running out of control, which we saw in the Great Depression. But I do think that we're going to see a number of bankruptcies, and that these bankruptcies are necessary as a part of what Schumpeter has called the term escapes me, creative destruction in the economy. Nancy is asking, what will be the impact if countries, particularly the US, open too soon and there's a resurgence of the virus? Nancy, this is what epidemiologists have included is in their scenarios. If you look at either the SFU study or the Imperial College study, they do have a scenario of opening up too soon. I'm going to try and get this right. If we open up too soon because of a decline in cases, there's going to be a second bump. As the number of cases rise again, we're going to have to shut down, reintroduce social distancing. There's going to be a prolongation of cases, and it's going to draw out the downturn. If you read carefully into the IMF's outlook, they actually have 3 scenarios in addition to the base case that I showed you here. One of the scenarios includes opening up too soon and a resurgence or a second wave. What we can hope for is that there will be a vaccine that by the time that happens, we'll be able to inoculate or at least treat people more effectively, and that hopefully the second wave will be smaller than the first. Justin, is there a potential for less developed countries to face complete bankruptcy? If so, what type of implications could arise? Yeah, thank you, Justin, for bringing in the global dimension. Here in Canada, we feel pretty comfortable with our government's actions as we've introduced stimulus. But believe me, there are already 100 countries internationally that have gone to the IMF to seek financial support. The IMF has actually, fortunately, increased their firepower over the past couple of years. They're making loans to many countries because many countries are being hit by the health shock, by the financial shock, and by an economic shock. And many countries are not in a good position to weather a long downturn. In Europe, as we've already seen, there's a debate amongst the European Union countries whether they can issue bonds that would be able to, that would fund where the rich and wealthy countries in the north of Europe are able to fund borrowing by the countries in the south to, if you like, practice insurance to help the European Union survive. I think that we're going to see, as you saw, Germany, the Netherlands, Northern European countries are resisting this, and we're going to see potentially a second European euro crisis, similar to what we saw with Greece. Just a few more questions before I stop. I know that I'm 5 minutes over time, but I'll see what I can get through. I will be putting this presentation online, so you will find it there. Someone has generously suggested I send it to the White House. I don't think they're listening to anyone, frankly. Certainly, we'd be all better off if they would listen to their chief medical officer. If most countries start to see the flattening of the curve by June, how long will the recession likely last? Well, if we do see the curve flattening by June, July, and a reopening in the second half of the year, slowly and gradual, that's where we think we're in the V-shaped scenario where we have really quite a sharp rebound in 2021. A lot of the spending that would be taking place in 2020 is going to be moved so that when we reopen, there will be an initial burst, restocking, both from households as well as from businesses. That's what's going to be driving the growth in 2021 of 5.5% to 6% in the IMF forecast. The question that a lot of people keep coming back to is inflation. Are we going to see inflation? Not until we see the gap between where the potential is in the economy and the actual GDP closing. You do not get inflation until that moves forwards. So even with governments effectively printing money with the central bank buying their debt, we hope that that reverses and that they're able to unwind that by the time the economy is at full at full output. Okay. With that, I want to thank you all. I just want to remind you with a couple pieces of advice. Please be aware that we all suffer from behavioral biases. It's well documented by Nobel Prize winners like Daniel Kahneman, like Robert Shiller, and by behavioral economists like Amos Tversky and others, that we suffer from overconfidence in the face of uncertainty. We are in a highly uncertain moment, which means we are probably all over-optimistic. Okay, be aware also of following trends, of reading only information that confirms your prior biases. The thing to do is to really look for a diversity of opinion, try and look for opposing views and pull out what you can. Don't look back with hindsight and say to yourself, I wish I could have figured this out. Instead, keep a journal right now. Write down what you think is happening, write down what you predict is happening and why. It will be very valuable for you as you go forward in your careers to learn from this episode and learn for the future crises. Avoid clicking on anything. Don't give anyone your bank information, your credit card. Avoid phishing because criminal activity is heightened at this type. Thank you very much, everyone. It's been a pleasure being here, and I appreciate your time and spending the extra moments with me today. And please stay healthy, and I look forward to seeing you all in person in the future. Thank you very much.